All right, Brandon's off today. He normally does market outlook videos on Thursdays, and we don't really cover for each other too often. But considering the circumstances and the market environment that we're in, I thought, you know what, I'll just pop in and quickly do a short little video and let you know kind of what I thought. In a short little video, after I got looking at charts, and this is kind of what I like to do, turn into a not so short little video. So watch as much of it as you want to. This kind of gives you some takes on my regular routine of looking at the charts. I've kind of deviated away from lately. You can remember, on YouTube, you can speed these up and watch it at 1.5 or 2 times speed if that helps you get through them a little bit quicker. But like I said, watch as much of it as you want. I kind of just got going, and there's a lot of interesting charts and patterns that I wanted to talk about, and you know, I just got going. So. But you know, again, kind of consider this a freebie because, like I said, Brandon's off, and this is just me getting at the computer and talking about what I saw today, and then I'll be back with my normal video tomorrow, as well as those who are subscribers, our Market Outlook live video that I do at 3:30 Eastern time, when I put the trade idea on before, as well as look at all the old trade ideas. So let's go ahead and get started today. Today is Thursday, March the 19th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. One positive sign here is that we're starting to get more doji patterns, right? We're starting to get small bodies, long shadows to the upside and to the downside. They're better to the downside. You notice we did not close above the high of the low day today. We didn't close above the hammer there yet, so that's a sign that the hammer is not a reversal pattern. So keep that in mind. You got to close above that. The near-term line also didn't get up above 50 yet, so it's still down in the lower half of the chart. Obviously, strong bearish posture, falling market sentiment, about as bearish as you can be there. But again, the fact that we're not closing at the lows now for 3 days in a row, for the past 5 days that we're not closing at the lows is a much better sign. It is still obviously to the downside, so it's not like we're out of the woods, but the selling's not as pressured anymore. And obviously, like I think they said today was one of the first days we went without a limit up or down in a while, so a good sign for the markets. All the way around, and like I said, the small body, despite the relative, I mean, it actually really wasn't. If you notice, it's probably our first below average range day that we've had in quite a while. I mean, without going back and looking at each specific day incidentally, but I would venture to guess that this is probably our first below average range day that we've had since the selling started on that Thursday and Friday, going into February expiration, when they were slightly, it looks like above average, slightly above average. So this being slightly below average and not quite an inside day. We did get a slightly higher high, but still, the bodies are right inside of each other. And so, again, it's not a sign that we're going to rocket up to the moon tomorrow, but it is a much better sign that things might be the selling pressure might be abating. We talked a lot today in our portfolio management class about what is it going to look like, and when we do bounce up in the short term, and what's the retest going to look like? So that was all covered in our class, and we might be in the mode right now where we're going to get a short term bounce up above 50 on the near term line, potentially up above 80. I wouldn't be surprised at all if that near term line jumped up above 80. I would not expect dark green shading. We might get light green shading with the intermediate line coming up above 20. It's not too common for, even in really bearish times, it's not too common for the intermediate line to stay down below 20 for too long. Here, I keep forgetting that I need to use a log scale here. And then not fit the studies, sorry, on this chart, because the studies cover the whole chart. So let's not show the studies here. There we go. So if you come out over here, you can see, again, we just don't get below 20. This was during January. This was during the October, that Q4 in 2018. And then you go back to 2008, 2009, right? Because everybody likes to look at that. That's the nice. So here's 2016. We were down there for a little bit with a cluster in there. But let's go back to 2008, 2009. That is all the way over here. And you can see, so when the bear market kind of got, when it really hit the fan that week in October, we came down, we came out of it. You see the near-term line got up above 80, just barely, and then we retested the 30-day moving average there, got a really bearish pattern, light green shading in the yellow line, about as, a very bearish pattern there. And when we get that again, that's going to be a selling opportunity for us to get pretty bearish for that retest. In this case, not only did we retest here, we went for a couple of days lower. But you can see, and a lot of people say, oh, we went to a lower low. Well, we didn't go to a lower low until these last 2 days. And those last 2 days were quickly reversed before and after options expiration. So it's not like we really hit a lower low. That was really kind of a anomaly there. We got clusters on both those days and rallied out of that, right? As you can see, the intermediate near-term line got up above, retested the 30-day moving average again, and then rolled. And then we did come down here and got all of these clusters in March, and things were really looking pretty dire. Again, we were not, we were still kind of holding these lows until this last kind of leg of selling that was just cluster after cluster after cluster. And you see how we started getting dojis down here? That kind of tells you that the selling is abating. And then we reversed with a big move to the upside and big move back to the 30-day moving average. And we had light green shading yellow line, it reversed, right? So that's kind of what I'm looking for here. I don't think we'll get to the 30-day moving average anytime soon. But I do think that will pop up. These dojis will reverse up and we'll make up some of this lost ground here. Just not everything, right? Not enough to get people to not be so dire anymore. If you look at the Russell 2000, well, here's the Dow Jones. You can see again the long lower shadows, the doji patterns forming there. The Nasdaq, lots of ups and downs, lots of dojis there too. Again, avoiding, and then you can see a little bit of an engulfing pattern on the Russell 2000. A little bit of a lower open from what was that, 991.16 yesterday to the open of 988, so about a 3-point drop. And then yesterday's open was at 1057.65, and today we closed at 1058. So not the best looking engulfing pattern there is, but by definition, that's an engulfing pattern. So it can be a short-term reversal, kind of following this Harami pattern right here. A couple of Harami, well, in fact, 3 Harami patterns. Boom, boom, boom in a row. So we'll see if that ends up being the short-term reversal pattern on these major indexes. Again, just enough to not necessarily get us, definitely won't get us to a dark green shading anytime soon, but at least will stop us pulling so far away from this 30-day moving average. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down there. That tells me 2 things. Number 1, you liked our video today. Number 2, you want us to do it again tomorrow. It's a quick way to give us feedback. We look at that on every video, so let us know what you think. If you don't want us to do videos anymore, you don't have to click on anything down there. And you can do that right now, even while you're watching. Also, while you're watching, if anything stands out to you, comment on the video and what you got out of it. And when people come watching for the first time, people instinctively, we'll check the comment section to see what this video is about and why they should watch. And so let them know what you got out of it and why they should watch it. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It'll take you to our page where you can subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching us here on our website, you can check out our Market Outlook trade review video. So every trade that we do on these videos, we trade them all the way to the time that we close them. And so from the time that we open the trade in these videos to the time that we close them, we track them with these Market Outlook live trade reviews. I do these every day on Monday, Wednesday, and Fridays. Every day I normally do the Market Outlooks. So click on that, this play button that will take you to the page where you can watch those videos and all the old archives as well. Here's our calendar of upcoming classes. You get access to all of our classes and these videos, these trade review videos, with our monthly subscription plan. There's our two different subscription plans. If you click on pricing, it will compare the two, so you can kind of see what you get with each one. We also invite you to engage with us on social media. Hit this little heart right there. It'll open up this page where you can like today's Market Outlook tweet. Hit this thumbs up icon that will take you to your Facebook account. You can like today's Market Outlook Facebook post. The more you engage with us on social media, the more those platforms will promote all of our content to your timelines and make sure you catch everything. So they promote the content you engage with the most. We try to make it really easy for you to do that here. All right, let's take a look at the long-term chart. You can see the PPO is starting to come down. It's going to get really low because of how far we are down. You know, it's going to be a while before we catch up to even to the 50, or excuse me, not necessarily that we catch up to the 50-day moving average, but the 50-day moving average catches down to us. So you can see on the Hakinyashi candles, you know, we're closing below, as of right now, last week's low point. You know, eventually you're going to get to the point where you get these lows and then the candle stays. Now here's a reversal candle, and I don't think we'll get a reversal candle anytime soon. But eventually you get these really significantly bearish candles like this, and you can see how the candle stays. See, it sets a low and it stays in there for a while, and you got this real significant bearish and it stays in there, and then, you know, eventually we got, you know, we're closing below these lows, and then we got this inside candle there, and that was a reversal candle. So that's kind of what you're looking for here. Is like, okay, that's a pretty significant low point on a Hakinyashi basis. Very unlikely that we'll close below that low point. Not 0%. Anything can happen. But more likely we're going to end up with, you know, a candle with a big body, but where the low is a little bit higher probably. At least for the next few weeks. Again, similar to what we saw not only here in August of 2015. You can see what happened here, you know, after the big selling here in 2016. Same thing there. You can see here's August 2011. Same thing happened there. And then, of course, 2008, you know, the same thing happened for multiple weeks there. Still some bearish candles, but staying within that range. And then the 50-day catches down to us, right? So expect that. I mean, next week's Hakinyashi candle, if, you know, again, we still got one more day in this, but you consider that the open is, let's see, sorry. The open, just kind of see the midpoint of the open and the close is 26.79. So the open is going to be probably right around where my cursor is. And then, of course, we're trading at 24.09, so we're below this week's close so far. Remember, the close in the Hakinyashi is an average of 4 different prices, the open, high, low, and close of the regular candle. So we're going to have a pretty decent sized body next week, and then we'd have to trade all the way down below 22.80.5 to get a lower low on the candle, and especially to close below that to get the average of next week's open, high, low, and close to close below 22.80 is very unlikely. So more than likely we're going to kind of trade with some bearish candles until that 50-day moving average, which means some ups and downs in this area. You know, if we do get a reversal candle like this, great, but highly doubtful, right? It's going to be more likely we get a big candle and we end up with multiple candles until that 50-day catches down. It's so far up above where we're at right now. I also mentioned too the 3 green arrows. You can see the volume still is the average volume is still really high, and we're still, well, there's the average volume at 192. We're still hitting 1.5 times. We've hit all these arrows are closes above the 1.5 times the average volume mark. We've closed with more than 1.5 times the average volume every day during this pullback, except for the very first day, right there, that very first day, and then 2 days ago. And we were just barely off of it. Every other day it's been more than 1.5 times, and the 1.5 times is really rising. So we've had a lot of volume, but you see how the MACD is changing. In fact, when you look at the regular MACD, not the regular MACD, but when you look at the the kind of more intermediate term MACD. Sorry, it's kind of over in this area. Well, let's do it here. Let's change this to a 12, 26, and 9. So give me 1 second to do that. So you can see that one's starting to turn up too, and that's a good sign. This is more this longer time frame is more associated with a 50-day moving average, whereas we use a 30-day moving average. That's why we use the 8 and 17-day. But you can see how things are turning up and looking a little bit better here. All right, but we look at the two-line versions. Let's take a look at the two-line version. And again, you know, the reversal here, I mean, we're still, look how far below the 8-day exponential moving average. The first level of reversal is just to get above the 8-day, and we're not even there yet. The next stage after that is to test the 17-day, which is actually, I expect on this short-term bounce that we get that we'll probably test the 17-day. It probably won't be at 275 by the time we get to it. You know, in the next couple, you can see it's dropping, you know, every day. So in the next couple of days, it's going to be probably in this area, around 265, and that's probably where we'll end up hitting it and testing it, and then coming, you know, rolling off of it and coming back down. So that's how it's kind of worked in the past. I wouldn't be surprised if that's the way again. And then after we fail at the first time in the 17-day, and of course this is kind of a general pattern. It doesn't always work out nice and neat like this. But if we hit the 17-day and fail, then the next low point won't be nearly as bad. Even though we'll probably retest these lows, it won't be as fast and dire. And then once we do break the 17-day, then we'll have to get to the 30-day, and that's where you'll get that pattern of like light green shading, light pink shading, light green shading, and a yellow line on the moving average, which will be a really bearish pattern. And that might happen right off the get-go. In fact, we might get that on the next near-term run. And if we do, and that would be kind of ideal, because it would represent a nice good jump, really hard, fill in these gaps, which is, you know, that's a pretty decent chance of that happening, and then get to that bearish pattern, that pattern of light green shading and yellow line, which would give us a great opportunity to reverse, you know, set up a lot of bearish, quick, short-term bearish trades to make that retest move back down to these lows. Just don't expect that retest move to last as quickly. It would probably take, you know, a few more weeks. This took about a week to get down in this area, a little bit more than a week. So it'll probably take about 2 or 3 weeks. If we were to jump really quickly up to the 30-day, probably be about 3 or 4 weeks working our way back down to these lows. Still bearish, still lower lows. Probably get a much higher low than this and set up a divergence. And keep in mind, you know, another reason why there's a good chance we get a big jump up to the upside, there's a lot of significant divergences. And, you know, again, just the target on these divergences is the high point in between. That's way up here. I highly doubt we're getting up to 3130, but can we get up to 2900, 2800 in this area? Definitely. On a quick short-term bounce, you know, to kind of get us new high points off of these divergences that we can then roll off of, come back down. You know, again, I wouldn't trust any new peak up here, up above on the RSI. I wouldn't trust any new, it might get above 50, but don't trust it until it gets above 60. Just like you wouldn't trust a drop until you got below 40. It's the same thing here. Don't trust a move up higher until it gets above 60. And even that's not 100%, but it's the best confirmation you have on that particular indicator by itself. All right, now let's take a look at the intraday chart. And I mentioned the intraday, you know, we are now 1 day away from not having the high, starting to move the high point. That's a good sign for us finally. Start moving this high point down a little bit. I mean, this rubber band's really stretched, and that's why it's, you know, our margin of safety to the downside now, considering that's, what, 110 points? That's about 30% of the high. That's a pretty big range for a small time frame. This particular small time frame being 4 weeks. You can also see, too, while it would be really easy to get up to 280 really quickly because there's not very much volume up above us. You do have to clear this level, and that's where the value area is in the 4-week period. But you know, there's the gaps and the gaps and the gaps, and I think these are the big 3 gaps. This one, the rest of this one, and the rest of this one that you would fill in, and maybe up to this 294 area where you fill in the rest of that gap and that one. the rest of that gap there, and then I think that's good. I don't think we're gonna. I mean, we could hit these too, but it's highly doubtful we'll be able to get through the 300 area and fill in the rest of these couple of gaps up at the top. So most likely going to be any move to the upside in the very short term. I'm talking like near term line, the blue line, the market forecast goes up above 50 on this current upward move. I think this is about as far up. But if you can get up there, and if you can get up to the 30-day moving average, which on SPY right now, and that of course it's falling, so in a day or two it's going to change, but right now you can see it's right about at 300. 302.79 is where it's at right now. So and it's falling because it was at 305.87 or 308. It's at 305.87, and of course, okay, so 305.87 is where it closed, and it's kind of projected to be at 302.79 depending upon where we open up tomorrow. So at 305.87, and you go back to the short-term time frame, that's way up here. That's about in this area. So we're probably not going to get to the 30-day moving average. And again, to get a yellow line, you have to close above it. This even just slightly, but you have to in 1 penny, and you get a yellow line. So more than likely, we're going to hit it down in this area, right? 295 to 280, depending upon how fast we go up. If we go up, of course. So if we do, that'd be great. I mean, you'd be filling in a lot of gaps on the way up here, a lot of these common gaps, and if we get a gap to the upside, if we gap up to 260 tomorrow, or maybe just 255, and we don't fill in any of it at all, well, that could very well be a runaway gap. Highly doubtful. We probably won't get a runaway gap until we until we retest these low points again, and then we're set up for an intermediate run where we get an bullish intermediate rally for a while. I don't expect that. I mean, that would make this a V bottom, and I'm not expecting it to be a V bottom. If we were to go now to the volume today, so I show you the volume. When you look at the volume relative, you can see the ATR now is slowing down. Finally, a little smaller range today. So it's starting to slow down a little bit. Like I said, today's range on the SPY was just a little bit above the average at 15 points. Well, that's where the average is right now. So for us to keep getting above average ATRs, we have to really get some significant moves. So the ATR is up high enough, and again, it's very similar to this concept. Eventually, when the realized volatility, you get this big move higher in implied volatility, but when realized volatility climbs up above implied, so when the historical volatility has been more volatile than what the market's expecting going forward, that generally sets a low. Not that we can't go lower, not that we can't retest these lows, but in the short term, it generally sets a low, and we get that near-term rally. Look at today's little gain here. It's the smallest one we've had since way over here. We had a little bit of a down day right there, a very small range on February the 26th. Very small range, very small loss. That's the smallest result we've had since this whole thing started, with a little small one that Thursday on February the 20th is where that started. So a good sign that things are kind of slowing down, that we're not getting so much pressure to the downside. And again, like I said, ideally we can start off with a gap to the downside, because again, if we gap up tomorrow, then we have to fill that gap in with a move to the downside. So ideally we gap down by 1-2% tomorrow, and then we open up and we fill in that gap to the upside and keep going, and make our way back up, at least to the 17-day, if not eventually get quickly up to that 30-day. And then, like I said, then we're going to have an opportunity to get, to set up some pretty bearish short-term trades there, and add some negative deltas to our portfolio. All right, but go back to the volatility index here, the VIX. Here we go. We showed the VIX was really coming down, but look at the VIX to VXV ratio. It's back down. It's testing the 1 level. It's back down to 105%. So we've really made, in other words, we've really settled down. It's still high. It's still in the 70s, but now it's not so much higher on the 30-day basis than it was in the 90, which it's kind of interesting, because what's happened is the VIX has been falling, and the VIX 3 months, which is that 90-day mark. I keep wanting to add that O, but that's, you notice it's not falling as much, and it actually went up yesterday when the VIX itself had dropped. So you can see that it's up to 69 now. It's been gradually moving higher, whereas the VIX itself is at 72. So it's just actually barely higher. So kind of like that historical implied volatility relationship. When that VIX, is when the VIX 3 months gets really high and the VIX falls below that, a sign that we've worked into a bottom in this area. And when I say a bottom, I don't mean necessarily like, okay, here we go, load up on all your bullish trades because 10 years from now we're going to have 30% of your returns for the next 10 years. No. I mean, I don't know where that bottom is going to be. It could be, we could have already had it. It might not be for a few months like 08 to 09. We might have a lower low there. It doesn't matter because 10 years from now, whether you get in now or a month from now or 4 months from now at a lower low, it's not going to, 10 years later, it's not going to make much difference. You're talking like 30% a year returns versus 28% a year returns versus 27% a year returns. Whether you got in today or if today is the low point or you got in a lower low. So people looking for the bottom, I'm not saying that this is the bottom, but there's a lot of these signs are showing us there's a bottom that's forming here, at least in the very, very short term. That should give us a nice little, that should abate the selling pressure and give us a little bit of a float, a little bit of a bounce, even if it's just to the 17-day, but preferably up to the 30-day, because then we can really attack that move with a retest of these lows after that. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there on the top right corner of your screen. Click on that link. It opens up a poll. You can either agree or disagree. If you click disagree, comment down below on why. What are you seeing? What charts or indicators are you telling you that we've got a lot more downside to go, or that we are V recovering way beyond the 30-day? That getting to the 30-day is going to be nothing on this next bounce. So share with us what you're seeing there. Of course, everybody's got their opinions, and people, especially on the internet, are more than willing to share your opinions. But it's more useful to see what's driving your opinion, what charts or indicators you're looking at that gives you that outlook, and share that with the community. All right, now let's take a look at what's driving this price action. It's interesting, this is a 3-month chart, and you can see, look at all these equities. The Russell 2000 is down 37% in the last 3 months. The S&P is down 25%. You can see developed markets, preferred stocks, emerging market stocks. Crude oil is down around 60% in 3 months. And really, at this first peak right here, when we first hit this first low, that's where bonds peaked and that's where gold peaked. And the dollar kind of stopped. That's where it hit its low. Since then, the dollar has rallied, but gold and bonds have really dropped off. We had another leg lower in equities, but this kind of divergence where we had, stocks selling off with rising safety trade, but now stocks selling off with falling safety trade, a little bit of divergence that a lot of this is selling kind of fluff. Another reason why we can really ramp back up here pretty quickly up to these highs to kind of to erase that divergence, so to speak. Let's take a look at just what happened here today. That you can see, here we go. So today was one of the biggest moves. In fact, I think they said it was the biggest move for WTI crude oil contract. Big time move to the upside. Of course, the ETF, not as big of a rally, but still 14% is a pretty decent move from one day. Preferred stocks also rallying up here. You can see small cap stocks at one point in time were up over 5%, and the S&P was kind of up and down throughout the day, kind of flirting with that low level. But a very good sign to see some outperformance in small caps. You can see emerging markets and developed still kind of lagging and not making very much of a move. And of course, gold dropping down. Now let's take a look really quickly here. Let's come off to this chart. Let's take a look at the market forecast and take a look at crude oil. There's the big move it had today right here, and I know it's a little bit of a move up. You can see we closed at 22.89. Today we closed at 20. We got up to 65 after a move up to 28. So from 22 up to 28 is a pretty decent move in one day. And you can see we're continuing up here. We're so far below. We've been coming down. Here's the weekly chart for crude oil. We had that big doji pattern. We've got the opportunity for this kind of a long lower shadow to develop here coming off of this cluster. Again, we're kind of looking for signs that the selling might be abating here. In fact, I think the biggest reason why we sold off this last leg, so there was that first low point where the risk appetite and bonds rallied, but this last leg where even like bonds and gold fell, I think a lot of the biggest reason why crude oil has fallen so much is because of the S&P has fallen so much is because of crude oil falling as much as it has, and with again its own kind of price wars, again between Saudi Arabia and that's this little drop right there, and the expectation of something like that coming right here. I think that's what's really driven a lot of the equity indexes down to such low levels. You saw, I just barely showed here, the 38, we're sitting at the 38, sitting at that 38 Fibonacci retracement level. For those who don't know, that goes back to the 2009 low point here. So if I were to go to a weekly chart, the 2009 low point. So this big move that we're now sitting at Fibonacci support. This is a big time Fibonacci support zone on a long-term basis, and so that's kind of where we're sitting at the top of that. So big important area that we can come down a little bit more, and that's where the volume support is, right in this area, right at the 50% level. So right smack dab in the middle of this Fibonacci support zone that we have, retracement zone. So, but again, going back to crude oil and to see how significant of a drop this was, we're breaking down below the 2016 lows, which is below the 2008, 2009 lows that came down from some real significant high points. With another reason why that this has really dropped as much as it has is take a look at what the dollar index itself is doing here. This is today, this is like tonight, going into tomorrow, but look at that big candle, these last couple of significantly large candles. The dollar's made this a tremendous move to the upside. In fact, in a matter of 1, 2, 3, 4, 5, 6, 7, 8, let's use it 9, I believe it's 9, 8 days. So 1, 2, 3, 4, 5, 6, 7, 8. So let me show you the rate of change over that period to show you kind of how significant, how often we get this big of a move over an 8-day period. We don't have a lot of history, so I can't go back too far on this, on this index here. Here's the XY. So in fact, I need to go back 9 days, don't I? Okay, there we go. So that would include now today's pattern, unfortunately, but now, you can see we're up 7%. To give you an idea of how fast that move is in context, to go back as far as I can. Again, we're at 7.7%, so keep that in mind. This at the end of this tail move, the tail end of this really bullish move we had in 2014, that set the high point in March of 15. That only got 5% move in this amount of time. You can see some other moves. Here's 2008 when things really hit the fan, right? We had a big move to the upside in safety trade. And there's that 1120 where we got the cluster on the S&P 500 where we hit that low point, and the dollar fell from there, pretty sharply fell from there. And then it rallied big and sharp. None of those moves in the dollar, as quick and sudden as they were, as bad as things got, none of those moves. In fact, we got up to 7.13. We got to 7.7 now. So That kind of shows. And then during all these recessions, we never got over 4% moves in such a small amount of time. That is a sharp, sharp move in a very small amount of time. And what that's done on some of these other kind of major currency pairs, you look at the euro US dollar and look at that drop down to 106, 105 to kind of give you an idea of what that looks like on a longer term basis. That's a pretty sharp move to the downside, down to some significant support levels. You look at the pound US dollar, another big currency, and look, I mean, that's a significant move down to 115. Like, we haven't been down that low on the pound US dollar in years, right? And years and years and years. This is going back all the way to 2001 when the dollar really hit its like significant peak back then at the end of that recession. That's the highest the dollar was, like at 120. And you notice we're at 116 now, and the lowest we got there was 138. So it's like this is a kind of a significant, very, very significant low point. Or at least we are hitting some significant lows in the dollar. One more look at the Australian US dollar. Look at that move down below 60 cents. And again, to kind of give you an idea, and let me make sure it doesn't fit studies, and we'll just use a log scale here. So again, going back the same 20 years, remember we're at 58 cents right now. To give you an idea again, so at this point we got to 63 cents when the dollar really rallied and commodity prices fell, and seeing how it impacted the Australian dollar. And again, here's where the dollar got the most. It got down to 50 cents Australian dollars per US dollar, and we are just about there again. So the dollar is making this kind of sharp, extreme move away to the, away from these lows. So, again, how sustainable is that fast of a move? As you saw, it's kind of hard to sustain that fast of a move, especially hitting some pretty like generational extremes on these major currencies. It's just setting up for a big sharp reversal on these. And again, that would be bearish for the dollar and would tend to be pretty bullish for risk appetite when the dollar falls that sharply. All right, now let's take a look at the sectors and how they're performing here. And you can see I've got one light green shading out of all of these. All the rest of them are dark pink shading and red lines, right? I've got one light green shading, and that is XLP. It's got the highest intermediate line out of all of them. Not surprising, right? Because right now seems like all these staple companies are doing the very best. But you can see staples, and if I look at the staple companies themselves, how they're performing on a relative basis to each other, you can see some are better than others. You can see we are taking advantage of that Hershey's move to the downside. You can see some of these other bigger moves, Cisco and Coty and Lamb Weston, Constellation Brands, Tyson Foods, all to the downside here. Coca-Cola, there's been a really good opportunity to take advantage of that move. On the other end of the spectrum, you can see Kroger outperforming, Clorox still a big winner, General Mills, Campbell's Soup, all these kind of food companies that people are going out and hoarding right now, all really moving significantly to the upside. Walgreens and Costco, Kimberly-Clark, Conagra, all outpacing XLP. They're all outperformers in their own sector, and of course just about all of these are outpacing the broad market as a whole. There's only a handful, literally a handful of these that are underperforming the broad market as a whole, which is pretty hard to do right now considering how the market's holding up. But all the rest of them are really moving, and really the only one that's kind of moving from an underperformer to potentially to being an outperformer is Budweiser here. But big move higher in terms of relative performance in these staple companies. If you were to look on the other direction, say, okay, well, which one of these sectors, is performing the worst right now? So that's the best performer. You can see if I look at these relative values to each other, industrials and financials and consumer discretionary are all kind of performing. Of course, energy, we kind of have to mark that out because this is 58% drop in 3 months is tremendously huge. But you've got outside of that outlier, You have financials, discretionary, and industrials, some cyclical areas that are performing the worst. I mean, some of these are rising, some of these are falling, but you just look at the numbers. Discretionary is rising at 12, and so is financials. Industrials is still falling at 13.75. But you say, okay, well, let's take a look at this relative strength chart for discretionary members. So we'll pull these up, and we'll go to SPX here. And you can see who the big loser. I mean, Amazon is still a big winner here. It's holding up in fact, it's really the only big winner besides Ulta Beauty, which is losing some momentum. But Amazon still remains a relative big winner versus the broad market as a whole. So on the other end of the spectrum, you look at all these cruise liners, this dropping off like a rocket. Kohl's is dropping down. Hasbro is still struggling. MGM, Expedia, anything travel related is dropping off like a rock. There's Nike. You can see Nike not so bad, but it's just barely starting to fall off. There's your home builders. They've been outperformers, and look at the big change in direction that they're all taking right now. They're all really starting to move sharply lower. Same with Best Buy and Tiffany to a small degree. It's still kind of rotating around. It's actually still it's even a bigger outperformer than Amazon is. But these three, the housing sector and Best Buy are really moving in the wrong direction here from a relative strength basis. Of course, everybody knows about all these, but these are movers right now, moving in the wrong direction. Interestingly enough, one of the stocks that's kind of related to those home builders that's actually rallying up on a relative strength basis, but might be losing a little bit of momentum and maybe rolling back along down with them, is Home Depot. If I take a look at its chart here, you can see the big time drop that it's had, and it's also had a big extreme move on its DMI with a high ADX. We've had higher. I mean, we had a bigger ADX over here, but eventually that came after the extreme move that it had. So it kind of went up and down after it reached this extreme level over there. Of course, looking at its market forecast chart, you can even see on a monthly basis for Home Depot. It's just barely turned, dark pink shading and a red line, but we're so far down below it on a monthly level, and of course on a daily level we're even that much more below it, and we're getting these long lower shadows, hammers, and engulfing patterns and harami pattern there, and there's opportunity for moves to the upside, but there's also opportunity. You saw the weakness, the relative weakness in the home builders. If you take a look at we're below the value area on the 1-year chart. If you look at the 5-year chart, you can see where we're at here. We've got some really strong resistance above us now with that volume area. You've got some very strong support below you at 135, and this is what it looks like here on the 10-year chart. Again, strong. You got some room to the downside here before you really hit go, because we've been kind of gradually moving up so far so fast on a stock like this. So whenever you got strong resistance and strong support in either direction, then what I like to do on those types of stocks. I like to say, okay, well, let's sell an iron condor. Well, the problem with a lot of these stocks right now is they got very wide spreads, which makes iron condors harder to do. And we've got capital, and we say, okay, well, if I were to say, okay, let's sell, instead of selling an iron condor, let's sell this 30 delta at 145. Let's sell this 185 delta at $4. I get $1,800. It's going to take me $3,200 of capital to make this trade. I say, okay, well, let's take a look at what that looks like in the Analyze tab. Here we are. Here's where the trade is. And you say, okay, well, that $3,200 is where I have to get closed out. So I'm going to add on this volume node here, and I'm going to put it right about at the $3,200 loss. That's when I would get a margin call to get out of that there. And then we'll move another one up here, so right about 3,200, right in this area. So those lines, if I were to throw on these slices to a chart, and let's get rid of the probability of expiring cone, so we can see it a little bit better. So that's where we're at there. this first two lines, and here, let me get rid of this line right there. Okay, so those first two lines are the break even. So again, big volume support above where we're at right now, and there's our break even up above that. And then a big volume support below where we're at right now, and that's our break evens below that. And then again, for us to really lose, twice of what we're trying to make, the $1,700, then the $3,200 our margin call on the short put, we'd have to go outside of these areas, so significant levels. So I've got a lot of room to work with after this extreme move. Which, generally when you get these extreme moves, like you see here, there's some divergences on the CCI, and the RSI is extremely low. It doesn't necessarily mean that we're going to bounce back up. We could to 180, but then also means we can test down the lows we've seen before when we got these extreme patterns. And this short strangle will offer me the opportunity to, depending upon how much I get, right? Because right now the natural is at 1405. So depending upon how much I get here, this short strangle will allow me to get a pretty decent return for the risk that I'm trying to take, and that would be the credit that I'd be willing to lose, would be that $1,700. So I'm basically soaking up a lot of capital because of the wide spreads of the iron condors. I'd be soaking up a lot of capital on this, but I have a pretty decent probability of achieving some degree of that return, that 1,800, as you can see where all my strikes are, where my break evens are. I have plenty of room and plenty of strong support and resistance levels to help me in those areas. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link right there that takes you to our Market Outlook forums on marketscholars.com. Open up any new threads that you want with any questions or comments you have about what we talked about in the video today. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group, as well as our community at marketscholars.com. Have a great rest of your evening, everybody, and we'll see you all tomorrow.